Hey guys, this is Nate Dodson. I'm the managing attorney over there at Crowdfunding Lawyers. I've been doing so many different conferences and speaking gigs and educational presentations, but frankly, at the end of the day, I have not been able to create as much just kind of educational content for our channels, for clients, for people that are really reaching out to and talking to. So I wanted to set up this extra, just kind of a day to teach a little bit more about, the newest, latest, best strategies to raising capital and how it's really working out there, in the real world. What my plan is to do kind of 10, 15-minute presentations on crowdfunding and the way it works, the real way that it works. Secondarily, there have been some new strategies that we've been implementing lately by doing multiple capital raises all simultaneously. And then there's good ways to do it and riskier ways to do it. And then finally, always ask, how should I structure my deal? What should I put together? What should the offer be to investors? And there's always, there's not a perfect answer. There's not one answer. So I'll go through again, kind of the different structuring strategies and the best way for you to figure out, what should I actually offer to investors? And with that, I'm just going to start with what crowdfunding kind of means and the strategies behind it and what it takes to actually get something launched. So with that, we will kick it into gear and start with, let's talk about crowdfunding. And of course, we always start off with that disclaimer because forever, at all times, it's important for you to be careful with what you're offering to the public in terms of advertising, to investors, and your communications are just really important. So take all this that I'm going to be covering as good education there, but frankly, at the end of the day, hire a good attorney, know what you're doing. But let's talk about raising capital for your business, for your real estate. If you're acquiring real estate, if you're acquiring a business, you're starting up, all of this can kind of come together and you're either raising capital from friends and family, you're bringing money out of your piggy bank, or you're reaching out to the world and saying, hey, I need this investment dollars. Here's what I'm doing with it. And that's what I refer to as crowdfunding. Crowdfunding, a great buzzword, one of those that doesn't mean Kickstarter. Well, actually, a Kickstarter campaign where you're pre-selling goods, that is a type of crowdfunding. But there's other categories like GoFundMe. That's more of a donation-based crowdfunding. And then there's crowdfunding with equity, which actually is what we focus on and what we do. To start with, if you're trying to do a crowdfunding, you're trying to reach out and find investors out there in the world, your first step has to be your audience. Because we get people all the time, they reach out and say, hey, I need to raise some capital. And the first response or the first question is always, where are you going to find your investors at? How are you going to raise the capital? And inevitably, either somebody has a bunch of experience in the space, they've already been doing syndications, they've already been working with investors. Great. That's a good starting place. But for the people that says, I don't know where it's going to come from, I'm going to go out there and start finding investors. I hate to say, if you're closing in 60, 90 days, oftentimes it is too late because you need to be creating your audience now and today. And what I mean by that is your audience is, the group that you're communicating with, whether you actually know them, you're connecting with them through social media, or you're building the know, like, and trust through email campaigns, newsletters. And one of the biggest recommendations that I always give to people is start your newsletter now. Send updates about what you're doing, whether you're starting a business, whether you're in real estate, doesn't really matter. Inform the world what you're trying to do and start with your email list. If you don't have an email list, there's companies online that will scrape your current email to pull out people that you've been emailing, that has been emailing you. And that's a great starting place with the reach out. Nowadays, you don't want to get spammed or get your emails thrown in junk. So there is a process if you need to reach out and ask, get consent to add people to your email list. But they're honestly the most likely people that will invest with you because they know you. Hopefully they like you, but it's all about building that trust. With social media, it's still the exact same approach. If you're including articles about the industry that you're in with your newsletter, if you're giving a blog that you're just creating your own, or you're doing your own social media, YouTube, or other content, this is what needs to go out there, both on your social media, creating value, whether it's within the Facebook groups, whether it's just on your friend channel, it doesn't really matter at the end of the day. It is all about getting out as much as possible. A great example is Alex Hermosi. He's got really a great book on creating leads. I would definitely recommend everybody read it. And one of his biggest points is you need more buyers, post more content. It's almost like a 1-for-1 offer. And he's absolutely right about that. So at the end of the day, you're trying to create this audience of people, prospective investors that know, like, and trust you. As you are doing this, you're starting to identify really what business you're targeting, what real estate you're going to acquire. You got to figure out what you're actually going to do with the investors. But kind of the point being, you got to start the audience creation, build your community before you even start offering what your investment may be. Once you have figured out what you're going to target, there is a process of developing the investment opportunity with your investors. Later on in this hour, I'm going to go do a deeper dive on the structuring and how that works. But just really wanted to point out, first, start building the know, like, and trust investors. Second, then figure out what you're actually wanting to target, because no matter what, you have to be building that confidence and figuring out what you're going to do with the money. And it also comes down to, they call it testing the waters, where you're looking for non-binding indications of interest that somebody may possibly want to invest with you. The secret being, once you identify the asset, once you get your offering structured and launched, those are the first people that you're going to follow up with to ask, do you want to invest too? Now, I'm not going to go too deep into the regulations, but I do want to point out at really a high level the different strategies that you can leverage with crowdfunding. The first, actually not a lot of people know about. It's called regulation crowdfunding. And with this, you're able to raise up to $5 million from absolutely everybody. Unlimited number of high net worth investors, unlimited number of, they call them non-accredited investors. They're not millionaires. They're not high net worth or high income. Everybody is allowed to invest. It does require you to put your investment through a FINRA registered crowdfunding portal. And there's 1,001 different investment portals that are out there. And I just want to make the point that most of them, the vast majority, can't do these regulation crowdfunding offerings because they are not FINRA registered. There is traditionally a rule that I absolutely agree with. Traditionally, people are raising capital under Regulation D. That generally limits you to only accepting high net worth, $1 million plus, or high income, making $200,000 a year or $300,000 a year as a household. Those Reg Ds generally are limited to that type of investment. And there's this saying that don't accept non-accredited investors because they're an unbelievable pain, and that's true. But it's true to the extent that you're asking for $50,000, $100,000, because that's a huge portion of their net worth. And they're afraid if anything goes wrong. That's where this regulation crowdfunding really kicks in to start to help. And that rule doesn't really apply because you're accepting lower dollar amounts from investors. So as an example, and I use this all the time, if there's a reasonable household income, it's technically more than $124,000, and they have a net worth. If they have a $500,000 net worth, as an example, they can invest up to 10% of their net worth. That's still an investment of $50,000. Now, if they're a retiree, they're younger, they don't have a higher income or a higher net worth, they can still invest up to 5% of the greater of those numbers. To use a similar example, but now it's a retiree and they don't have an income. Well, if they have a $500,000 net worth, they can still invest up to $25,000. Nothing to forget about, but there are these limitations with crowdfunding. How much people can contribute also changes the dynamic of it's not as big or as much of a portion of the investor's net worth. So it's a lot easier to work with multiples. The other type of regulation that we really consider as part of this crowdfunding is Regulation D, Rule 506C. Now, I've beaten up these regulations to death. Regulation crowdfunding is a little bit of a newer animal, but I do just want to bring this up briefly because with this Reg D offering, the 506C, you're allowed to advertise online, do your webinars, do your email blasts, ask for investments through social media, but you're limited to the verified accredited investors. And if you get online right now, you're going to see a ton of, here's an investment opportunity, but it's limited to accredited investors. All of these guys are doing these offerings under Regulation D, Rule 506C. So really, I love these different strategies, and I'm going to dive much deeper into this. But there's strategies to be able to combine investment offerings. I call these concurrent offerings. And there's ways to do it where you can do first a Reg D 506B, which allows you to work with some not high net worth investors, but you're not allowed to advertise. I don't really talk about it in terms of crowdfunding because frankly, you're not allowed to crowdfund because you're not allowed to advertise it. However, a very normal strategy that we recommend on a regular basis is you can start with doing a Regulation D 506B, close it, reopen as a 506C offering, allowing you to advertise. Now, there's another strategy, which this is actually the combining and having the offerings at the same time period. You can technically do a Reg D 506B at the same time as the 506C, but there's some requirements with this, namely, you had this relationship with the investors before you ever started this Regulation D 506C, before you started the CF, the crowdfunding offering. As long as those investors are coming to the table, not from you getting out there and advertising your investment, you're actually still allowed to accept it. These are different investment offerings that are offered at the same time. Each has to meet all of their own respective investment regulation requirements, but it does allow you to really expand your target and what you're doing to bring in capital. I'll go a lot more deep into this, but what I absolutely love, and we're calling this the side-by-side strategy, where you can run this Regulation D 506C with the accredited investors alongside with a regulation crowdfunding. Now, if you're only trying to bring in for your new business less than $5 million, it doesn't need to move forward with this type of a strategy. But if you're in real estate, you know $5 million doesn't go too far. That's one of the big reasons why this regulation crowdfunding hasn't been leveraged or used very much. But by running side by side, the unlimited capital strategy of this Reg D 506C, the accredited only, at the same time as the regulation crowdfunding that allows you to accept everybody. Now you've created a platform that you can market and advertise online and everywhere, but at the same time, be able to accept anyone. Unlimited number of non-accredited investors, up to $5 million, an unlimited number of accredited investors through the Regulation D. So this is where starting to combine opportunities really makes a world of difference in what options and what strategies you can leverage. Just to really re-emphasize what crowdfunding means. It is advertising. They call it general solicitation. It's getting out there in the world and telling everyone, this is what I'm doing and I'm looking for you to invest. And it's allowed under these regulations, Reg D 506C, unlimited amount of investment, limited to the verified accredited investors. Other one is this regulation crowdfunding that allows you to accept anybody, but now you're limited to only raising up to $5 million. Now, there's very few people that this big, large option of a Regulation A really makes sense for. We do them on a very regular basis because of the number of social media influencers that we work with. But what this Regulation A allows you to do is raise up to $75 million from absolutely everyone. Now, either you have a massive audience with tens of thousands of investors that may potentially come into a REIT or a large fund. More often than not, we set up more of a syndication investment platform that allows you to take that $75 million, chop it up into smaller bite-sized bits, and now you can raise money from an unlimited amount of the non-accredited investors, unlimited amount from the accredited investors. I say that the cap is $75 million. Well, there's the big daddy, but this is where I really love this combining offerings, because with the Regulation A, it takes a long time. It costs a lot. Great target is within 3 to 6 months, be able to launch a Regulation A. It goes through qualification process. It is expensive. But by doing the regulation crowdfunding at the same time, side by side with the Reg D, it really cost-wise, it's about 80% cheaper to go this route. And you still have the ability to raise as much money as what you need instead of not having any cap on the non-accredited investors. It's just a cap of $5 million. So there's a good way to be able to leverage all of the strategies. I had mentioned with the regulation crowdfunding, and this is really 80% plus of the hundreds of deals that we put together at Crowdfunding Lawyers, leverage investor portals. If you need any recommendations, there's a bunch of them that are just fantastic out there. Shoot me an email. We're always happy to share introductions to investment portals, to marketing agencies. At the end of the day, building your investor community and getting them to easily invest through an investor portal is the secret of making your life as easy as possible while expanding your reach absolutely everywhere. If you're doing one of these crowdfunding, the regulation CF offerings, I just want to make the point that with these required FINRA funding portals, they will have their own due diligence requirements. You will have a escrow account where your funds go into. It takes a little bit longer. There's a little bit more of a process behind it. So make sure that you are planning your timeline accordingly. On average, if we're putting together an investment opportunity, it takes us legally around 3 weeks to get it on the table where you're accepting money. And Reg D, you're really accepting money by the end of the month. With this regulation crowdfunding, you will have to tack on a couple more weeks. 30 days, 45 days, not because of the legal process, but because of this due diligence that you have to go through with the crowdfunding portal. There's also financial statement requirements, and ultimately you also have to go through due diligence with the escrow companies. So it tends to take a little while. So I just wanted to point that out. Now, this is really important just so that you're aware. There's different types of documentation that comes together based on the type of investment offering. I'm going to bring up this Reg D 506B. It's very similar to the Reg D 506C in that everybody is tending to hear about a PPM or a private placement memorandum. The other documentation that comes together, it's really the same regardless of the type of investment offering you do. But like a LLC has an operating agreement, sometimes it's called a company agreement. You always want to have your business plan, a pitch deck, and your financial analysis. To draw a distinction between those, your business plan may be 20, 30 pages plus of really detailed information about your investment and your business plans, where a pitch deck has maybe it's 5, 10, 15 at max pages of very little information. It is more of a bullet point information approach, but with nice, pretty pictures. So when you're sitting in front of an investor and talking through something, well, you're not trying to use this 40-page business plan. It's a much shorter, much more graphically interesting presentation to talk through investors with. And at all times, you need to have these financial analysis. You got to know, well, in part, how you're structuring, why you're structuring, and it always comes down to what's the financial analysis. A PPM, the private placement memorandum, it is called a private placement because generally it's private. It's not registered with the SEC. It's not filed with the SEC. There is Reg D notice. There is some information that gets filed with the SEC, but in large part, they don't know much. With the regulation crowdfunding, there is a Form C. It's basically the same thing as a PPM, but it in fact gets filed with the SEC. That makes it a little bit different than a PPM. It is public information and public knowledge. And the last difference between the crowdfunding and the Reg D is there's generally financial statement requirements. It's just a little bit different. Definitely be working close with your attorney so that they can get you all of the requirements, the information there. But it's either reviewed financials, companies certified financials, or audited financials. I'll dig in a little bit more to what that means, but you just have to be aware and know that there are additional requirements, and that also takes a little bit of extra time. So that's the first kind of informational presentation I wanted to go through. If you have any more specific questions, and we'll get to the ones that are in the chat, please shoot me an email, go through the QR code to be able to reach out. You also receive a lot of helpful charts, some manuals for structuring your investments, etc. But here's a great way to connect with me. Now, to go to the questions that I have that have popped up. Coin and card auctions have done 2 Reg CFs and moving into vertical markets via JVs. Want to discuss the best avenues moving forward. Reg CF, I will just mention, it's a great way, especially if you already have a business, you have clients. Your clients are already your audience. You can go right back to the people that are already working with you and say, hey, do you want to be an investor in the business that you're already providing information, providing funds? They're already buying, they like you, they trust you. That's where the regulation crowdfunding, you can target your own customers in order to become the investors. You mentioned JV. That refers to a joint venture. The biggest concern and fear I always have with joint ventures is if you just have a joint venture agreement, it qualifies as a general partnership, which there is no limited liability with. So you have to be very careful and always use an LLC or corporation for the joint ventures. But to get very specific into the risks of doing joint ventures, if you are consistently doing these LLC after LLC, joint venture after joint venture, if there's any issues or problems, it's still, you end up with investors complaining. It's just inevitable when there is a loss. So that's something to really watch out for. And even if you're doing a bunch of single investor JVs, single investor LLCs, regulators or the SEC may look at what you're doing at a higher level. With a securities, with an investment, it is a pooling of funds. And most people think, well, if I'm only bringing in one investor per LLC, I'm really not pooling funds. But the reality is if you're funding your business by paying yourself, contributing to your primary company through these joint ventures, the scheme of financing of your business may be through the multiple joint ventures that you're doing. That may lead to some liability, so you just have to be careful. Definitely, if you have more of a joint venture, a JV approach to your business, make sure you're working with an attorney, whether it's us or anybody, that knows and understands the investment regulations and the risks of not doing things right. Another question, does Crowdfunding Lawyers file the Form C and submit due diligence creative copy for marketing? The answer is generally. Just to explain kind of if we're helping with a crowdfunding offering, and the same applies for any other type of investment offering that Crowdfunding Lawyers helps with. On the front end, we're always spending 2-3 hours, help structure the investment, providing coaching, consulting, answering questions, making those suggestions. After that, the entities are formed. The Form C is prepared, and simultaneous to the legal process, we're kickstarting and making the introductions to the investment portals, the escrow companies, and introducing auditors. Everything can move forward generally very simultaneously. But at Crowdfunding Lawyers, we're attorneys. We don't prepare the marketing material. However, we're happy to review your marketing material and compliance and reviewing emails, pitch decks, business plans. All that absolutely is a part of what we do with the overall service. But if you need introductions to marketing agencies, graphic designs, we do make introductions. They're third parties. Your deal ends up with them.